everyone. My name is Cassandra Dorn, and I'm a certified financial planner with Provident Financial Consultants. I'm here today to talk to you about things that we'd like to discuss with our clients, and that is IRA investments and common mistakes that we find that people make without knowing it. So let's dive right into things because we only have about 20 minutes, and I want to make sure we cover a majority of the information that we go over with our clients on a day-to-day basis. So today I am bringing to you top IRA planning mistakes to avoid. Now, this to me is somewhat of a picture of the past, right? This just screams confusion. Back in the day, this was more of a common sight, I feel like, when planning out a trip than what we have with today's technology. However, I could compare it to the same. About 15, 20 years ago, I'm going to date myself, I was planning out my route to take my Series 7 security exam. And it was a very nerve-wracking exam for me. And so I wanted to make sure I knew exactly where I was going. So I planned out my route. I even looked up what the building was supposed to look like on the internet so that I wouldn't get lost. Even with the best intentions and the best planning, I still could not find the building. I circled it, and my panic started to grow. So what did I do? I sought out the advice of an expert, basically someone who worked at a gas station nearby and would know the area. And when I walked in and explained what business I was looking for, they laughed and said, it's a common occurrence. It's not a well-marked building, and told me exactly where to go. That is how we look at IRA planning with regards to retirement. Even when we have the best intentions and do our research, sometimes small mistakes can lead to errors. And that is where investment professionals can come in and be extremely helpful. So let's go into the first IRA mistake we commonly see. The first mistake that we commonly see, or I commonly see, is making an error in beneficiaries. And this can be done just by overlooking a simple beneficiary designation form. A lot of times people either get handed a beneficiary form and never fill them out or turn them in. And that's possibly due to starting a new job, getting a packet full of information, and the beneficiary form for the 401k or the 403b or the employer sponsor plan is in there, and you simply just don't fill it out. It happens. Life is busy. The second mistake we see is that the forms are outdated or the beneficiaries are outdated. So I know back when I had my first job and I was asked to name a beneficiary IRA, I named my parents, right? I probably owed them a lot of money for paying for my schooling or my brand new cell phone. And so I thought it was right that if something happened to me, I leave what little I had saved to my parents. Now that has changed. Now I'm married and I have kids. And if I haven't updated those forms, I'm pretty sure my husband's going to be angry with me if something happens. And instead of him receiving my IRA and our life savings, I should say, my parents do. So again, looking at life events that could cause these forms or beneficiary designations to be outdated. Marriage is one, divorce is one, a death is one, a death of a beneficiary, kids, charities, maybe your views towards a charity change, or you want to incorporate more than one. But the important thing to note is whomever or whatever company or non-for-profit is named as a beneficiary on your IRA, that is the primary designation as to where those funds will go if something happens to you. They trump the will. So if the will says, you know what, it should go to XYZ's spouse, but the beneficiary form says, no, it's going to XYZ's ex-spouse, it's going to go to the ex-spouse. Now, the new spouse could, in the state of Wisconsin, go to court and fight for 50% of that IRA asset and will most likely win. But it's not the best thing to leave on your spouse's plate. So again, it's very important that we review these forms annually if possible and make sure they are correct and up to date. And last but not least, an inconsistent beneficiary forms or leaving different beneficiaries named all over the place, right? So maybe I updated my life insurance to my spouse, but I didn't update my 401k. And again, that's still going to my parents. So making sure I review all of the documents wherever I have named a beneficiary is important. A common one that I often ask clients about are their health savings accounts. Now, that's not exactly an IRA, but it is an account with a named beneficiary. And oftentimes when I'm going through clients' general financial plans, we find that they didn't name anyone on that specific account and they have the ability to do so. So again, just taking the time to review every account that could have a beneficiary and making sure they are consistent with where you would like those funds to go if something were to happen to you. The second mistake is a newer mistake due to some tax law changes that have occurred over the last year. Not planning for taxes on an inherited IRA. When you don't plan for taxes on an inherited IRA, you can have a little bit of a tax surprise when you go to file your taxes. So let's talk about the options for beneficiaries on the IRAs and how those could be taxed. The first option, most common option that we find for beneficiaries is a spouse to be named as primary. And when a spouse is named as a primary beneficiary, they have specific options for them and how they would like to handle that account. We're actually going to talk about that on the next slide. So we're going to kind of skim over the spouse section here. However, if you don't name a spouse and you name, let's say, a child or a parent, those options are very different. Based on the new rules, if you name a beneficiary that has more than a 10-year age gap, so they're 10 years younger than you, they no longer can take distributions based on life expectancy. They now have to take distributions and have the account fully liquidated within the 10th anniversary of your death or the owner's death. Now, this means that they no longer have to take a tax distribution every year or a distribution from an IRA or a Roth IRA every year. They can wait until that 10th year and take the entire amount all at once. Now, this is where some planning comes in mind, and you may need to pull in a tax professional. If you inherit a sizable IRA that is all pre-tax and you wait until that 10th anniversary, that could be a pretty hefty income tax bill that you need to pay. Now, I have a client who inherited an IRA and has yet to take a distribution based on the new rules because this client is thinking of retiring in the next several years, and we see that her income may decrease. And so we are holding off on taking some of these distributions based on what we project her tax bracket to be in the near future. Now, if said client was thinking they were going to retire in year 9, I don't know if I would take this approach because depending on the size of the IRA, this still may not be the best solution. So again, it's very important to sit down and talk with a tax professional and or an investment professional to figure out how to best take the money out of an inherited IRA based on your current financial picture and your future financial picture. So now let's circle back and let's go back to a spouse inheriting an IRA. Now, the spouse is not tied to that 10-year rule that I just talked about. In fact, the spouse has a couple of special options, I would say. The first thing to be cautious of is if you inherit an IRA and you are under the age of 59 and a half, so you are a young widow or widower, you have a choice where you can roll your IRA into your own IRA, or you can open what we call a beneficiary IRA or spousal IRA. If you open a spousal or a beneficiary IRA and you are under 59 and a half, you can take distributions from that IRA without incurring an early 10% penalty and early state penalties if they apply. If I take that entire inherited IRA and roll it into my own regular IRA and then want to take money, that's where I would have that 10% early distribution penalty imposed and state tax penalties imposed as well. Plus, the entire distribution will be taxable as income, whether I take it from my own IRA or, in fact, if I take it from a spousal or a beneficiary IRA. On the flip side, if I am older than age 72 and I am currently required to do required minimum distributions, and my spouse who predeceased me was not quite at required minimum distribution age of 72, I may not want to roll those funds into my own IRA because that will make my required minimum distribution even larger. Whereas if I rolled it into a beneficiary IRA, I could wait a few extra years to take a distribution from my beneficiary IRA instead of adding more distributions onto my existing IRA. Last but not least, if I decide I don't want the funds from my spouse's IRA, or I would like to disclaim, as we call it, or not take, and maybe give to my kids or a charity. If I immediately roll my spouse's IRA into an IRA in my name, I have now taken away the ability to disclaim or disregard that account, and in fact, allow the contingent beneficiaries to take it instead. So it's always extremely important to be thoughtful about how you would like to distribute those assets, because once distributed, a lot of times that is a permanent decision. And so therefore, we like to take our time, go over the pros and cons of any which way we could take those distributions and make sure we're making an educated decision as to how we are going to roll the funds out. Another common error with regards to IRAs is to do an indirect rollover or not utilize a direct transfer. So when we look at possibly consolidating an old 401k into an IRA, so we don't lose track of things, or we try and possibly simplify, where we have assets, so we don't have as many things to keep track of, or you simply just don't want to hold that old IRA out there. You're unhappy with the investments, or you just simply want to consolidate. How do we go about doing that? Well, there's two ways. The first way is to do a direct rollover. That means you request the funds be sent directly to the new fund company that is custodian of your IRA. For example, if I have a 401k at XYZ company and would like to consolidate those funds into my IRA at ABC company, I would request and fill out the paperwork for XYZ to issue a direct rollover with the check made payable to ABC company FBO Cassandra Dorn. They may send me the check and I would then forward it on to ABC company. However, I don't need to sign that check because it's not technically made payable to me. It's made payable to ABC company. I did a direct rollover. If I do an indirect rollover, what I'm essentially asking my XYZ 401k provider to do is to issue me the check directly. Now, what happens when I go this route to do a rollover? Well, when that check gets issued, I have exactly 60 days to deposit those funds and reissue a check or get a deposit into ABC company for that amount. Now, mind you, this is 60 calendar days, not 60 business days. If I do not have this done in time, the entire amount of my rollover from XYZ company is now taxable to me as income. And if I am under 59 and a half, I will receive a 10% penalty on top of that for early distribution and any applicable state tax. Now, also, if XYZ company withheld any taxes, some 401ks or 403bs do have mandates to withhold 20% federal taxes if you ask for a distribution that is not a direct rollover. So if I had $100,000 at XYZ company and I asked them to issue me a check, I could possibly receive a check for $80,000 instead of $100,000 because they withheld $20,000 for federal income tax. When I turn around to deposit those funds into my ABC IRA, if I don't deposit the full $100,000, I will have taxes due on the 20 that was withheld. And if I'm under 59 and a half, they're going to assess an early 10% penalty on the $20,000 that was sent to the IRS on my behalf for doing an indirect rollover. So long story short, when possible, do a direct rollover. It makes things much more streamlined and it takes a lot of the guesswork out of it. The other thing to note is if you do, in fact, do a indirect rollover, again, that's where the funds would come to you first and then you turn around and deposit them. You are only allowed to do one of those every 12 months. Now, this is not a calendar year. It is every 12 months. So if I do this in June 15th of this year, I did an indirect rollover. I cannot do another indirect rollover until June 16th of next year. So again, these are all small nuances that if you decide to go the route of requesting an indirect rollover, just be very careful how and when you request those funds. Now we're going to go into the fifth IRA rollover to be very careful of, called the net unrealized appreciation. Now, this is not a common thing that we see every day. In fact, in my career, I've only done this twice, but in both cases, it was very worthwhile to explore. So what does net unrealized appreciation mean, and how does that apply to IRA mistakes? Well, net unrealized appreciation comes into play when you have a 401k or an employer-sponsored plan that allows you to have stock of that company bought within that plan. Now, when you go to retire or if you leave, you have the option of rolling out the company stock into a non-IRA account, a non-qualified, we call it, account. And what happens when you do just the company stock out of the 401k into the non-retirement or non-IRA account is you are taxed on the cost basis of that stock. So you are paying income tax on what you paid for your company stock. Then when you deposit it in your non-IRA investment account, any appreciation that occurs within that stock after a year, when you go to sell it, is only taxed at capital gains rate. This can be extremely beneficial for people who have company stock at a low basis. Now, remember, most distributions from 401ks, whether they're from the 401k directly or rolled over into the IRA and then distributed, are taxed as income. Okay. When we can take a chunk out of an employer-sponsored plan, pay taxes on the cost basis, and have that unrealized gain then come out taxable at capital appreciation rates, that can be extremely beneficial for the owner. However, this is how to go about doing this is extremely detailed in particular per IRS guidelines. So if this is something that applies to you, I strongly encourage you to talk to a tax and investment advisor because you may find it's worthwhile, but you again want to make sure you do it correctly so all of the benefits of the net unrealized appreciation are received by you and there are no errors that would take this benefit away. Now we're going to move forward. We've talked a lot about distributions, right? How do you take distributions from inherited IRAs? How do you get your company stock out in the most efficient way? How do you roll out your funds from an employer-sponsored plan or an IRA into another one? Let's switch gears and let's talk about savings into IRAs. One common mistake I've seen is not taking advantage of Roth IRAs. People are only focused on the now. I don't want to pay taxes now, so I'm going to save all into a pre-tax IRA or a pre-tax 401k or 403b. And I'm going to collect every tax savings I can now. That's great. But sometime in the future, you're going to need those funds to live on. And when those funds come out, they are going to be taxable to you as income. Another IRA tool that we can use to help minimize income taxes later is a Roth IRA. With a Roth IRA, you usually do not have any tax savings now, meaning the money you're using to fund this Roth IRA is after-tax money. It is deposited into a Roth IRA, and hopefully with some investment returns, that account grows. And when it grows, let's say my original deposit was $6,000 and I hold it for a very long period of time and I see investment returns that bring that total up to $10,000. Well, this is not guaranteed. It's for example purposes only. If that investment is now $10,000 when I retire and I want to take money out of that account, as long as I've had the Roth for over 5 years and I'm over 59 and a half, those gains will come back to me tax-free. In fact, the entire account at that point would be tax-free to me because remember, the money I used to start the account was after-tax money. And then the gains, because I have held it again for over 5 years and I'm over 59 and a half, will come out tax-free to me as well. Now, the one thing to keep in mind is being able to participate in a Roth IRA can be directly impacted by your income now. There are constraints that can disqualify some people from contributing to a Roth IRA. However, if you have a Roth 401k option or a Roth 403b option within your employer-sponsored plan, there are no income restraints associated with those types of accounts. So you would be able to participate through your employer-sponsored plan even if you cannot participate in an outside Roth IRA plan. So these are all important things to keep in mind. And again, this is an important thing to talk about with your tax professional to see if they think it is worthwhile, especially if you're looking to add it to your plan. Again, along those lines, not maximizing contribution limits. Again, focusing on the savings towards the last part of this presentation. Besides participating in an employer-sponsored plan, if you're able to, you may also be able to contribute to an outside Roth, like I previously discussed, or a traditional IRA. For the year 2021, individuals under the age of 50 are able to contribute up to $6,000 into an IRA. If you are over the age of 50, you can contribute an additional $1,000 into your IRA or Roth IRA. Now, the important thing to note is that is a total amount. So if I am saving $3,000 into my Roth IRA, I can also do another $3,000 into my regular IRA if my income levels permit. If I was doing a full $6,000 into my Roth IRA, I cannot contribute anything into my traditional IRA because I have already hit those contribution limits. For some clients, what we encourage them to do when looking at their specific situation is to fully maximize their employer-sponsored plan on the pre-tax side. This brings down their income and maximizes their savings on their retirement for their employer-sponsored plan. And by doing this, sometimes it can bring their income low enough for them to contribute to a Roth IRA outside of that plan. So essentially, they get to do some extra savings outside of the retirement-sponsored plan, which works out really well, especially when they're excited towards retirement and maybe want to retire early. So that's about it on the contributions. However, a common misconception when it comes to contributions is I need to work in order to participate. This is not exactly true. If you have a spouse who maybe does not work outside of the home. They're taking care of parents, they're taking care of kids, or possibly they are just not able to work due to a given circumstance, but their spouse does, and they file a joint tax return. In that case, that spouse, even though they don't have their own earned income, have the ability to do a contribution into a regular IRA or a Roth IRA if the spouse has earned enough to cover that contribution. So what does that mean? I have a couple of retired clients. He works outside of the home. He has a very fun part-time job and he earns $14,000 a year. He does a Roth IRA contribution for $7,000 every year, and she does as well because he makes enough to cover both of their contributions. Now, if he were to cut back, let's say, and only earn $10,000 a year in his fun part-time job and still contribute $7,000 to his Roth IRA, she would only be able to contribute $3,000 to her IRA because between the two of them, their contributions cannot exceed what he has earned. So again, it's important to note that just because one of the spouses may not have earned income does not mean they cannot save into IRAs. I always joke, in the state of Wisconsin, we're a community property state. What's mine is mine, and what's mine is his. So we share alike. And that is the same with earned income and contributing to IRA savings accounts. And last but not least, we're going to circle back to taking the wrong required minimum distributions. This is a big one. This is somewhat common. It's gotten a lot of press, especially within more senior magazines, because it is such a big deal, but it's easily avoidable. So with regards to required minimum distributions, at a certain age, you are required to take out of 401ks, 403bs, and IRAs. The one account I did not say is a Roth IRA. Under current law, required minimum distributions are not applicable to Roth IRAs, but they are applicable to Roth 401ks and Roth 403bs. So those are included in this conversation. The only thing that isn't is a Roth IRA, a regular Roth IRA. So required minimum distributions, what does that mean? Well, right now, under current law, at age 72, the IRS looks at the market value of your IRA, 401k, or 403b, and or all of them at the end of the year, December 31st. Then they state, based on your age, you are required to take at least this much out of these accounts. Now, people have asked me, why do they do this, Cassandra? And my simple explanation is, well, this is pre-tax money. This is money you have not paid income tax on. And you could have started these accounts way back when you're 20. So this money has been sitting in there for 52 years, never taxed. The IRS wants you to start spending it, right? And in spending it, you're going to pay some taxes on it. So that's my very simple explanation of why they require it. But nonetheless, it's required. So at age 72, they do a calculation and you are sent a letter, usually in January, stating how much you need to take out of each of your accounts. Now, if you don't take anything or you don't take at least these amounts out, there are penalties and they are severe. The penalty is 50%. So an example, I have an IRA and I was sent my required minimum distribution notice stating I needed to take out $5,000 during the year 2021. Now I have until December 31st to get that money out. But if I don't get that money out, or let's say I only take $2,000, so I am $3,000 short of my full required minimum distribution, that $3,000 will still need to come out. But on top of that, I need to pay a 50% penalty of $1,500. That is 50% of the $3,000 shortage that I did not take out. And remember, because this money has never been taxed, I still have to pay income tax on all of it. So we need to be very, very careful when checking required minimum distributions to ensure that these penalties are not imposed on our clients. The other thing to keep in mind is the difference between an IRA and a 403B or a 401k. When computing the RMDs or the required minimum distributions of two IRAs, let's say I have an IRA at XYZ and I have an IRA at ABC, and I need to take out $4,000 out of XYZ and $6,000 out of ABC. Because they are both IRAs, I can take $10,000 out of XYZ and call it a day. I can take 5 out of each. I can basically do any combination I want as long as I total $10,000 between the two. But if I have a 401k at XYZ and an IRA at ABC, same scenario, $4,000 out of XYZ and $6,000 out of ABC, I need to take $4,000 out of my XYZ 401k and $6,000 out of my ABC IRA. I need to do two distributions for at least those amounts because they are not essentially coded the same. One is an IRA, one is a 401k. They're not the same, so two distributions need to come out. Again, these are small details. They're very hard to remember, and that's what called for this presentation. We want you to be educated. We don't want you to make these mistakes. So I was mistaken. I wasn't on the last slide. I got a little too excited. There's actually 2 slides left. So let's jump into the second to last slide, I promise. Not considering qualified charitable distributions. So what are qualified charitable distributions, or QCDs, as we like to call them at Provident? Qualified charitable distributions are when you would like to give to a charity, and instead of you writing out a check directly to the charity, you have a check issued to that charity directly from your IRA. Whether that check is mailed directly to the charity or mailed to you first and you hand deliver the check, that does not matter. But it's essentially how the funds are paid to the charity. Again, they are not paid to you first. You are not depositing them, nor are you turning around and writing a check. The check is being issued directly from the IRA, payable to your charity of choice. Now, why would you do this? Well, when the standard tax deductions for federal taxes increased significantly a few years ago, what we found is it was better for some clients to consider the qualified charitable tax distributions when we looked at their income taxes with their tax professional. So the tax professional was saying, hey, by issuing a check to the charities from their personal accounts, they're not getting as large of a tax deduction as they could. It may be beneficial for them to do a QCD from their IRA instead. Now, why is there a difference? Well, when you do a QCD from your IRA, essentially the money isn't being paid to you and therefore it's not taxable to you. That's the shortened version. There's a few extra forms you'll need or your tax preparer will need to fill out on your tax return in order to take advantage of this qualified charitable distribution. But long story short, these have become more popular over the last several years because of that standard deduction increasing, and it just is more beneficial. The thing to keep in mind is in order to do a qualified charitable distribution, you have to be at least 70 and a half when you request the distribution. 70 and a half used to be the old required minimum distribution age. Now, if you remember from a slide ago, the RMD age is now age 72. The qualified charitable distribution age did not change when they changed the required minimum distribution age. So this one stayed at 70 and a half. So once you're age 70 and a half, it may be useful for you to talk to your tax advisor and or investment advisor about qualified charitable distributions and how they can fit into your giving plan. Last but not least, paying unnecessary penalties. This one is like a punch to the gut to me sometimes. I don't like paying early penalties if we can get around it. It just kind of snowballs a bad situation. So early distribution penalties, I mentioned them briefly on the spousal beneficiary discussion a few slides ago, that 10% early withdrawal penalty. If you're under age 59 and a half and you would like to do a distribution from your IRA, in most cases, you will be assessed an early distribution penalty of 10% on the federal level. And if your state has an early distribution penalty, which Wisconsin does, you will also be assessed an additional penalty on the state level. Keep in mind, any distribution from a traditional IRA is also taxable to you as income. So again, you have income tax, plus you have early distribution penalties. Now, there are some ways we can work around this, but they need to be done in a thoughtful manner. One of the ways we can get around an early distribution penalty is by utilizing substantially equal periodic payments, what we call 72Ts. This is an IRS code. So this would state, if I would like to take a distribution from my IRA and I am under age 59 and a half, I can do so without a 10% penalty as long as I abide by a few rules. One, my distributions must be done annually for at least 5 years or until I'm 59 and a half, whichever is greater. So if I am 55 years old and I need to do a 72T and I want to start those distributions, they will not end at 59 and a half, they will end at my age 60. Now, if I want to do this at age 50, again, whichever is greater, 5 years or 59 and a half, I will be taking payments to avoid this early distribution penalty until I am 59 and a half, whether I need them or not. This is a very, very delicate investment tool, and it should be done so with thoughtfulness and with a tax advisor involved, just to talk to you about the implications of having that income stream. Because again, even though we're not paying that 10% penalty, we still have income taxes due on those distributions every year that we have to take them. So how do they calculate what you need to take? Distributions are calculated using one of three methods: life expectancy, which generally is the smallest distribution, annuitization, or amortization. Amortization generally results in the largest distribution. So those are your bookends. We have life expectancy with the smallest, annuitization in the middle, and amortization being the largest. As long as these withdrawals are made in accordance with the requirements of Section 72T, there are no penalties on distributions from IRAs before the owner turns age 59 and a half. But again, be careful. Failure to follow the rules can cause a retroactive 10% penalty on all distributions. So again, this can be utilized. It is something that I have utilized in the past, but very carefully. So I want to thank you for joining me for today's presentation. I hope you found it insightful. And of course, if you have any questions, please feel free to send them to me at info@providentfc.com. Thank you and have a great day.